Hey everyone, it's your guy coming at you live from the US perspective. And today we are diving deep into something that should have every German auto executive waking up in a cold sweat at 3 in the morning. For the first time in 20 years, two full decades, Mercedes, BMW, and Audi. The holy trinity of German luxury engineering have simultaneously lost ground to three local Chinese brands in what used to be their golden goose market. China, and here's the real kicker, even massive, unprecedented across-the-board price cuts, aren't moving the needle. The era that defined China's luxury auto market for over 20 years. It is overdone, finished, caput. Now let me give you the number that is keeping the boardrooms in Stuttgart and Munich up at night. The number that is genuinely terrifying them. In April and May of 2026, not a single BBA model managed to sell more than 10,000 units in China. Let that sink in for a moment. The Mercedes C-Class, which used to be a guaranteed bestseller, sold 9,950 units. Just 50 cars shy of the 5-digit mark, 50 cars the Audi A6 L4449, the BMW 3 Series 9,107 over the past 10 years. This has never happened. Not once, not even close, and this is happening at a time when the overall Chinese auto market is still enormous. Now, I know what some of you might be thinking. Sitting there in your living room in the US, I don't live in China. I'm not buying a car there. Why should I care about what's happening on the other side of the Pacific? Fair question, but let me flip that around for you. Take a good, hard look at the BBA vehicles sitting in your local dealership lot right now. The gleaming Benzes, the sporty BMWs. The sleek Audis, how much longer are they going to hold their value? How much longer is that brand prestige going to command a premium on the resale market? Because what is unfolding in Shanghai and Beijing right now isn't some temporary market hiccup, some seasonal adjustment, some minor blip that will correct itself next quarter. This is a structural collapse. This is a tectonic shift. And when the single most profitable engine for these global giants starts sputtering and seizing up the entire machine, including the one in your backyard, feels the vibration. The whole global auto industry is going to feel this earthquake. Let me hit you with the raw data because this isn't a minor fluctuation. This is a full-blown 5-alarm meltdown. In the first quarter of 2026, Mercedes sold 158,500 units in Europe. That's a 7% increase year over year. In Germany itself, the home market sales jumped 9%. North America, 89,500 units, up 16%. The United States market, specifically, a massive, roaring 20% surge. Now, China, 111,600 units, a brutal, gut-wrenching, eye-popping 27% plunge. Three major markets, three completely different trajectories. Europe is climbing steadily. North America is roaring ahead. China is in a full-blown freefall, dropping off a cliff. And this isn't a one-month anomaly. Mercedes has now posted 17 consecutive months of declining sales in China, 17 months in a row. That's not a bad quarter. That's not a few bad months. That's a long-term, deeply entrenched trend that shows absolutely no sign of reversing. Now let's talk about BMW. Global deliveries in Q1 2026 came in at 565,780 units, off just 3.5% overall, which seems manageable at first glance. Europe was the only bright spot, with deliveries of 236,400 units, up 3%, and Germany itself up 10.7%. But here's the gut punch, the real kick in the teeth, China BMW's largest single market in the entire world. The market that was supposed to drive its future growth only moved 144,000 units in Q1, a 10% drop. And among all of BMW's major global regions, China posted the steepest decline, the deepest drop. At its peak, China accounted for a staggering 33.5% of BMW's global sales volume. 1 out of every 3 BMWs went to a Chinese buyer. That number has now crashed 25.5%. Let me put that in plain English for you. 1 out of every 4 BMWs used to be bought by a Chinese customer. Now it's down to 1 out of 4, but that share is shrinking fast. And with it, BMW's global profit margins, its economies of scale, and its ability to invest in future technologies. BMW's sales in China now represent a smaller and smaller slice of a smaller and smaller pie, and Audi Q1 global sales, 360,100 units, down 6.1% overall. China delivered 127,100 units, a 12% year-over-year slide, a sharp and painful drop. But North America was even worse for Audi, slammed directly by U.S. tariff policy adjustments and the rollback of EV subsidies. Audi's North American deliveries plunged 27%, with the US market moving only 29,886 units, marking the first time since Q1 2012, more than a decade ago. That quarterly US sales have dipped below 30,000 units. That's a decade low performance. That is alarming. Now, add all three German luxury brands together. In Q1 2026, they collectively sold roughly 382,700 units in China, at a decline of more than 15% compared to the same period last year. If you spread that out over 90 days, that means BBA sold about 69,800 fewer cars in China than they did a year ago. That's an average of over 700 fewer cars every single day, 700 a day. And if you zoom out over 2 years, BBA's cumulative annual sales in China have collapsed from roughly 2,300,000 units to around 1,820,000 units, a loss of nearly 500,000 customers. 500,000, to put that in perspective, that is roughly equivalent to Porsche's entire global sales volume for an entire year. Every single Porsche sold worldwide, from the 911 to the Cayenne to the Taycan, for 12 full months. Gone. Poof. Just like that, wiped out, and the situation got even uglier, even more brutal. In April 2026, the overall Chinese auto market tanked 21.5% in April. A staggering decline. Mercedes sold just 32,000 units, down 33.3% year over year. BMW, 34,000 units, off 24.4%. Audi, 29,000 units, down 25.6%. Same brand, two entirely different worlds. In North America, you might still see customers waiting in line for a new Mercedes. In China, they are looking at the worst sales slump in a decade. In Europe, the BMW iX3 might be flying off dealer lots. In China, dealerships are drowning in unsold inventory, cars sitting on lots for months, gathering dust, costing money every single day. This isn't a cyclical downturn, the kind that happens every few years and then recovers. This is a structural rupture, a fundamental break. So what do you do when sales crater, the classic playbook, the tried and true strategy from the past, slash prices? At the start of 2026, BBA launched the most aggressive, coordinated, across-the-board price war in Chinese automotive history. BMW was first out of the gate. 31 of its core models saw official factory price reductions. 24 of those dropped by more than 10%, 5 by over 20%. And the flagship electric i7 saw a jaw-dropping cut of over 300,000 yuan. That's roughly 42,000 US dollars. The Audi A6L dealer transaction prices broke below $30,000. Some dealerships were moving old model A6LS, originally priced around $45,000, for as little as $26,000. The Audi A4. You could walk out the door with one for under 10 grand. A brand new Audi for less than $10,000 5 years ago. That would have been completely unthinkable. The Mercedes GLC out the door prices in some regions dropped below $28,000. The Mercedes E-Class base transaction prices fell to around $30,800. These are prices that would have caused riots a few years ago. Now, basic economics says when you cut prices this aggressively, demand should spike, right? Supply and demand, lower price, higher volume. Wrong. The opposite happened. Sales kept sliding, kept falling, kept collapsing. One Audi dealer put it in brutally frank, almost despairing terms: we simply don't have customers. The cars aren't moving at a dealership in southern China. A salesman pointed to a showroom, a 6L, with a sticker price of $45,000, now marked down to $26,000, and said, "We get plenty of lookers, plenty of people walking through the door." But almost nobody signs on the dotted line when a discount is big enough to buy a whole other entry-level car. You don't get a buying frenzy, you get consumer paralysis, buyer hesitation, and a complete freeze in decision-making. Why? Because consumer psychology flips in a dangerous, self-reinforcing way. When an Audi A6L drops from $45,000 to $26,000, buyers don't think, what an amazing deal. I need to buy this right now. They think, what's wrong with this car? Is it really worth that much? Is there a quality problem? Is the brand dying? And if I wait another month, will it drop even further? That is a death spiral. Once the price structure collapses, the brand's perceived value collapses right along with it. Mercedes' average transaction price fell from $45,000 to $41,000. Audi crashed below the $29,000 threshold. Meanwhile, in 2025, Harmio's, Otto's, Ado, and Stellato brands averaged $37,600 and $35,000 respectively, already above Mercedes' $32,400 and BMW's $31,500. By Q1 2026, NIO's average selling price had jumped further to $39,000. The traditional luxury brands are losing their pricing power, and once that is gone, it is extraordinarily difficult to get it back. The brand premium is evaporating. And then there is the depreciation nightmare, the resale value catastrophe. In 2026, 3-year residual values for Mercedes sat at 55.9%, BMW at 50.9%, and Audi below 50%. Let me translate that for you in real dollar terms. You spend $30,000 on a brand new luxury car, and 3 years later, it is worth just 15 grand. You lose half the car's value in 36 months. That's not ownership. That is self-inflicted financial harm, burning your own money. And the brutal irony, even those massive discounts didn't stimulate demand. The more prices dropped, the more buyers held out, waiting for the next cut. The next bargain, the next desperate move, cut $5,000 today, they will wait for $8,000 tomorrow. Cut $8,000, they will wait for $10,000. The marginal effect of these price reductions is approaching zero. Price elasticity has basically disappeared. Now let's talk about the dealers, the foot soldiers on the front lines. The people actually trying to sell these cars, they are getting absolutely crushed, squeezed from every direction, losing $2,000 to $3,000 on every new car sold. Selling below cost has become standard operating procedure, the new normal. One dealer ran the numbers. If it costs $20,000 to get a car on the lot and you sell it for $18,000, that's a $2,000 loss per Volt vehicle. Sell 200 cars a month, and you are burning $400,000 in cash just to keep the doors open, just to pay the electricity bill, just to keep the lights on. Dealership profit models used to rest on 3 pillars: new car sales, after sales service, and finance kickbacks. Now, 2 of those 3 pillars have collapsed. New cars lose money every single time one rolls off the lot. Finance kickbacks have been curtailed by new government regulations, cracking down on high interest, high rebate schemes. After sales service is the only lifeline left, the only thing keeping these dealers from going under. One salesperson admitted flatly, "We're basically selling cars just to get people in the door for service." But here's the catch, the cruel twist. Electric vehicles require less frequent and lower margin service visits than internal combustion cars. Fewer oil changes, fewer brake replacements, fewer mechanical repairs. So even that last straw, that last lifeline, is getting thinner and thinner by the day. Dealer satisfaction with manufacturers hit a record low of 53.37 out of 100 in 2025, the worst score since tracking began over a decade ago. Over 90% of dealers expressed dissatisfaction, with luxury brands leading the pack, the most unhappy of all. And the exodus has begun, a mass exodus. In 2025, nearly 5,000 new car dealerships shut their doors across China, boarded up and abandoned. Major luxury dealer groups filed for bankruptcy, some of them household names in the industry. In Beijing alone during Q1 2026, Mercedes storefronts dropped from 34 to 27 closures, 7 dealerships gone. BMW 24 to 17, 7 more gone. Meanwhile, NIO dealerships jumped from 19 to 32, Xiaomi from 12 to 34. Shut one Mercedes store, open a NIO, shut a BMW. Open a Xiaomi. This isn't a random occurrence, some isolated event. This is a systematic, structural power shift in the distribution network. The balance of power is changing. Take Beijing Huayang AO Tong. Once the city's largest Audi dealer, a flagship store. The crown jewel, in December 2024, they terminated their Audi franchise and switched to Harmonious Auto. BMW pulled 37 dealership licenses from Guangwei Baoxin, one of the largest dealer groups in China. Beijing's Yuntong Group eliminated all its BMW locations entirely. Even BMW's global flagship 5S store in Beijing, their showcase, their temple to the brand, shut down in October 2024. Guangzhou's Jingxi Audi defected to NIO. One dealer investor told me in confidence, "We're losing 2 to 3 million yuan a year, about $500,000, and over 2 years that adds up to $1 million loss. But we're hanging on by our fingernails, because if we close, we eat the lease penalties, severance costs, and bank fines all at once." The pain of closing is worse than the pain of staying open. These guys aren't just exiting. They are in full retreat, running for their lives, and the inventory glut absolutely staggering, mind-boggling numbers. At the end of April 2026, total dealer stock in China hit roughly 2,600,000 vehicles. And of those, 1,900,000 are gas-powered cars, the cars that are becoming obsolete by the day. Those gas vehicles sold only 530,000 units in April, nearly 40% fewer than the same month last year. Now think about the carrying cost, the financial drain. One dealer told me that a single car sitting on the lot cost 150 yuan a day in interest alone just to finance that inventory. Multiply that by 1,900,000 vehicles, and you are burning 280 million yuan, about 40 million US dollars every single day just in interest charges. $40 million a day. That is not selling cars. That is trying to stop the bleeding, trying to keep from drowning. And when BBA finally cut dealer sales targets in late April, dropping them by roughly 20% for Mercedes, 24% for BMW, and 22% for Audi, with some Audi stores operating at just 70% of previous quotas. It barely made a dent. Dealers reported that the relief was not significant because the market itself is shrinking. Even with lower targets, they still can't move the metal. As one dealer put it with grim resignation, almost a black humor, we complain every single year about not making money. But looking back, each year might have been the best one we ever had. Read that again. Let it sink in. Sales down, prices down, dealers fleeing, inventory piling up, and now the product itself is failing to compete. Let's talk about the products because this is where the existential fear really sets in for BBA. This is the heart of the matter. The electric vehicles they are selling in China are mostly gas platform conversions, EVs built on old combustion engine chassis, the same underpinnings as their gas-powered cousins. Range is mediocre, tech is outdated, the software is clunky, and Chinese consumers are voting with their wallets decisively and overwhelmingly. In Q1 2026, Mercedes EVs made up just 224% of its China sales, barely a rounding error. The EQS sedan, their flagship EV, 89 units a month, 89. The EQA, 2, you heard that right? 2, not 2,000, not 202. And the EQS has had multiple quality recalls damaging the brand. It is essentially being phased out, the plug being pulled, the all-electric CLA from October 2025 to January 2026. It sold about 1,600 units in China. In Europe over the same period, over 25,500 units. Same exact car, two markets, a difference of more than 15 times. And by May 2026, the class monthly sales crashed to 21 units. Let me repeat that, 21 cars in a single month. That is Mercedes electric vehicle performance in China. That is the result of decades of brand building. BMW isn't much better off, not by a long shot. The i3 launched in March 2022 and has averaged about 2,000 sales per month, a steady but unimpressive number. In the same segment, the Xiaomi SU7 and Xpeng Mona are topping 10,000 units monthly, a five-fold difference. BMW has made the tough decision, the painful call. From July 2026, they will halt production of the China-made i3, iX1, and other converted EV models. These cars are being euthanized. But here's the brutal timing issue, the gap that could kill them. The old iX3 was discontinued in 2025, and the new class iX3 built on a dedicated EV platform won't arrive until Q4 2026. That leaves a nearly year-long product gap, 12 months with no new EV in that segment. Meanwhile, the gas-powered X3 gets a new model just 1 or 2 months after the old one stops. For EVs, it is a full year of nothing, of empty showrooms, of lost sales. In today's Chinese auto market, 12 months is more than enough time for hungry, aggressive, fast-moving competitors to feast on your market share. To swallow your customer base whole, Audis Even X sold 802 units in April, wholesale jumped to 1,968 in May, but retail was only 400. Pre-sales were hyped, heavily promoted, 15,000 small orders nationwide, the headline said. But you barely see any on the road. That gap between orders and delivery reflects production lag, supply chain issues. But more importantly, it signals buyer hesitation. People are not following through. BBA is caught in a brutal trap, a pincer movement. Old products won't sell. New products aren't ready. The converted EVs are being rejected by consumers too little, too late. The next generation dedicated platforms are still months away from showrooms. And in that dangerous, gaping window, Neo Li Auto, Xpeng, and Zeekr are devouring their market share. In May 2026, Chinese brands commanded over 70% of the premium SUV segment. The core BBA SUV models, Mercedes GLC, BMW X3, Audi Q5, all dropped below 8,000 monthly sales. The three combined 20,908 units, less than the Li Auto i6 alone. Think about that. Three of the most iconic SUV models in the world combined outsold by a single Chinese model in the price range above $20,000. Every SUV that sells over 5,000 units a month is now an EV. BBA has effectively lost the SUV battlefield. They have been outflanked and outmaneuvered. Chinese premium EV brands are now setting the pricing and product standards. They are the ones defining what luxury means in the electric age. BBA still has capital, technology, and global brand power, huge advantages to be sure. But in China's high-end market, there is no obvious reversal in sight. No clear path back to dominance. People say BBA lost to Chinese EVs. That is true, but it doesn't go deep enough. They lost to an era, a paradigm shift. In May 2026, China's new energy vehicle retail penetration hit 62.9%. More than 6 out of every 10 cars sold are now electrified. Plugged in from about 5% in 2019 to over 25% in 2022 to over 60% in 2026. That is a leap that keeps accelerating, with each step taking less time than the last. The growth is exponential. Domestic brand NEV penetration, a staggering 81.4%. Gas cars now make up only 18.6% of local brand sales, essentially becoming marginal, an afterthought. Chinese brand overall market share was 42.3% in 2020. By 2023, it broke 50%. In 2025, it hit 68%. And in April 2026, a single month record of 75%. 3 out of every 4 cars sold in China are now Chinese brands. In the $30,000 plus segment, domestic EVs now hold 62.7%. In the $30,000 to $50,000 price band, Chinese brands jumped from 11.2% in 2022 to 43.7% in Q1 2026, and they are on track to exceed 50% for the full year. The trend is relentless. We are seeing a fundamental shift from brand-driven purchasing to product-driven purchasing. Consumers don't care about heritage. They care about what the car can do today. BBA's EV penetration in China, BMW at just 6.2%. versus the overall market average of 54.1%. That is a factor of nearly 9. For the full year 2025, BBA sold fewer than 300,000 pure EVs in China, while NIO, LI Auto, and Xiaomi each broke 200,000. Each of them individually outsold the entire BBA EV lineup. And here is the real gut punch, the one that keeps executives awake. BBA customer loyalty has dropped below 18%. That means over 80% of existing BBA owners choose a different brand when they replace their cars. 80%, that is a structural shift that is incredibly difficult to reverse. Once you lose a customer, they are gone forever. Luxury used to mean heritage plus mechanical engineering excellence, V8 engines, leather interiors, precise handling. Now it means intelligence, connectivity, seamless digital integration, and user experience. BBA got into EVs early. But their early cars were gas platform conversions with slow tech upgrades, clunky interfaces, and limited over-the-air capabilities. As of 2026, their smart driving and cockpit systems still lack deep integration, trailing far behind local brands, models like NIO S9, Lyle 9. And 80 M9 are priced 50 to 60% below comparable BBA models. Yet they offer superior features, continuous OTA updates, better service networks, and more advanced autonomous driving functions. This is structurally similar to what happened in the smartphone industry between 2010 and 2020. The shift from Nokia and Motorola to Apple and Huawei from hardware to ecosystem. When the rules of the game change, the former kings become the biggest losers. The incumbents get disrupted. Now, I don't want to give you the impression that BBA is just rolling over, surrendering without a fight. At the 2026 Beijing Auto Show, they still had prime floor space, the biggest booths, the most prominent locations, but this time, they are not just proving they can build luxury cars, they are scrambling to prove they can build smart cars, connected cars, competitive EVs. BMW is hyping China-specific research and development and local digital ecosystems. Audi is pushing a co-developed smart platform with SAKIC. Mercedes is putting Chinese LED smart systems into its new EVs. What used to be the German fortress, engines, transmissions, chassis, mechanical tuning, is now giving way to screens, LiDAR, cameras, and artificial intelligence. The power to define luxury is shifting from German engineering to China's smart EV ecosystem. BBA hasn't lost their luxury badge, but they are rapidly losing the ability to unilaterally set the standard. They are no longer the ones making the rules. They are taking three major steps, a three-pronged strategy. First, clearing out the old inventory, cutting their losses. BMW will halt all converted EV production from July 2026. Mercedes is phasing out the entire EQ line. These models are dead in the water. No nostalgia, no mercy, no sentimentality. Second, arming next-generation products with Chinese tech. The new A-Class iX3 uses a dedicated EV platform with 6th-generation cells, 800-volt architecture, over 900 kilometers of CLTC range, and smart features co-developed with Chinese partners. By the end of 2027, BMW plans 40 new models with this design. The electric GLC has a native platform, 800-volt tech, Momenta smart driving, and a voice assistant powered by Dubao AI, with Chinese teams leading the software development price tag, $45,000 to $55,000, 10 to 15 grand, more than local flagship models. That premium used to be justified by the badge alone, the three-pointed star. Now, not so sure, not so confident, Audi even X rides on a co-developed platform with SAIC, and it is so new, so different, that it doesn't even carry the traditional four-ring logo, signaling a fresh start, a clean break in China. All three have chosen the same path: keep the physical body, borrow the soul from China. Third, easing dealer sales targets. In Q2 2026, BBA cut retail targets by roughly 20 to 24%, with some Audi stores operating at just 70% of previous goals. Because pushing high-pressure sales would just mean more subsidies and more losses, it is a financial black hole. Accepting short-term volume drops is the financially disciplined move. The only rational choice, this dealer relief window, is exactly when premium EV brands are poaching their best retail partners. More and more former luxury dealers are shifting to brands with clearer, more sustainable profit models. If BBA can't show them a path to profitability soon, network erosion will mean even deeper market share loss. The big unknown is whether their upcoming new energy vehicles will hit sales and profit targets. If they fail, if the new class doesn't sell, if the electric GLC flops, if the A7 X underwhelms, the current relief is just delaying the inevitable, and we will see a double collapse, sales and distribution together, a perfect storm. None of these fixes are easy. Scrapping old products means giving up whatever volume remains, accepting that those cars are unsellable. Adopting Chinese tech is an admission that for a century they fell behind, and for German engineers, that is a heavy, almost unbearable psychological blow. Easing dealer targets means accepting more pain on the earnings reports, accepting lower profits, lower margins. The brutal reality is that even if these steps are right, even if they are strategically sound, they might not be sufficient. The new Class AX3 doesn't arrive until late 2026. The electric GLC pricing won't be announced until July 2026. Audi Even X only moved 400 retail units last month. Meanwhile, Li Auto and Zeekr are already crossing 10,000 monthly sales. Month after month, BBA's new cars are still on the way. While their rivals are already at the finish line celebrating, as one industry veteran put it, BBA has learned the rules of China, but they haven't found their soul yet. They know how to survive here. Chinese tech, Chinese supply chains, Chinese research and development. But when your soul is defined by someone else's tech, are you still the same brand? That is the existential question. So why should you, as an American viewer sitting thousands of miles away in your living room in New York or LA or Chicago, care about any of this? Let me give you three concrete, personal, wallet-related reasons. First, BBA's global strategy is now being fundamentally rewritten by China. On June 16, 2026, BMW dropped a bombshell, a nuclear warhead, full-year profit margin forecast, cut from 4 to 6% down to just 1 to 3%. The stock plunged over 6% to a 5-year low. Mercedes and VW followed, their stocks tumbling, dragging the entire European auto sector down with them. This wasn't just another earnings report, another quarterly filing. It was effectively a surrender note, a white flag. The reason, three words: the China market. BMW's group pre-tax profit for the year is expected to drop by over 15%, with operating profit shrinking by 3 billion euros. That is roughly $235 million at current exchange rates. BMW management explicitly cited significantly increased competitive pressure in China as the number one factor. The primary cause, tariffs, will also drag about 1.25 percentage points off auto margins. Asia, especially China, is eating into per volt vehicle profits. The Chinese market, once BMW's largest, accounting for 33.5% of sales, has now fallen to 25.5%. That means when the biggest single market implodes, headquarters in Munich can't stay neutral. They cannot ignore it. Research and development budgets, product planning, global pricing strategies, manufacturing footprints, all are being forced to change because of what is happening in China. The next BMW you buy in the United States might well be a direct response to pressure from Shanghai and Beijing. It might have different features, different pricing, different positioning. Second, residual values are shifting, and that affects you directly when you go to sell or trade in your car. China's price collapse is already rippling into global used car markets. When a brand new A6L sells for $26,000 in China, the entire global A6L used car pricing structure takes a hit. Arbitrage opportunities, cross-border pricing pressure, and consumer expectations all start to shift. You might feel that when you try to trade in your Mercedes or BMW 5 years from now, the depreciation curve is getting steeper, and that cuts into your wallet, your trade-in value, your net worth. Third, and most importantly, how long will BBA stay strong in the US market? The Mercedes EQC is a perfect case study, a cautionary tale priced in China at $22,900. It sold only 161 units in May. In Europe, thousands per month. Same car, a hundredfold difference. BBA sales in North America and Europe are still growing. North America up 20% for Mercedes. Europe up 3% for BMW, but how long can that growth last? China's new energy vehicle share globally hit 61% in the first 4 months of 2026. In Europe, Chinese EV brands just broke 15% market share for the first time. 1 in every 7 new EVs registered in Europe is now a Chinese nameplate. In January-April 2026, Chery exported 147,700 units to Europe, up 264%. BYD exported 98,300, up 29.7%. When these brands bring not just lower prices but product superiority, already proven in China's hyper-competitive, cutthroat market, BBA overseas will face what they already experienced at home. In May 2026, EU passenger car registrations rose 3.2% to 955,000, but gasoline sales fell 20% and diesel dropped to 69,500. The internal combustion tide is receding in Europe just slower than in China. But the trend is unmistakable and irreversible. How long before BBS North American growth stalls? When Chinese smart EVs go global en masse, and they are already planning it, that day might come sooner than you think, sooner than Wall Street expects. So if you are in the market for a luxury car right now, whether in the US, Europe, or anywhere else, the real question isn't should I buy a BMW? It is, am I buying into a brand that is still relevant, or am I buying into an era that is being rewritten as we speak? Because what is happening in China today is very likely the preview of the global luxury car market in just a few years. You are watching the future unfold. Here is some actionable advice from an American perspective, practical things to think about. 1, if BBA hasn't started offering big discounts in your local market yet, be cautious. Do not jump in. It is not that they don't want to cut prices. It is that they haven't reached that point yet. Global pricing is linked. The pressure from China will eventually reach your shores. Don't be the guy who buys at the peak right before the crash. 2, if you do start seeing discounts, don't just jump at the first number you see. Do your homework. Figure out if it is a normal seasonal promotion or a glut-driven clearance sale. If it is the latter, the first cut is just the beginning. Wait, and it will likely go lower. Patience pays. 3. And this is the big one, the takeaway: stop measuring luxury by old yardsticks, by heritage and history. The definition is being completely rewritten. Smart cockpits, advanced driver assist systems, over-the-air updates, seamless connectivity. Do you have that in your current car? When you sell it 5 years from now, what will buyers actually care about? Brand halo is fading. Product strength is the real moat. Buy the product, not the logo. Finally, I want to hear from you. Where are you watching from? Is BBA still raising prices in your area, or are discounts starting to show up? Drop it in the comments. I read them all, every single one. That is it for this one. Stay sharp, stay informed, keep your eyes open, and I will catch you in the next video. Peace.